Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 3, the adjusting process from corporate financial accounting. So the purpose of Chapter 3 is to introduce the adjusting process. So at the beginning of the chapter, we'll discuss the cash basis method of accounting. And under the cash basis method of accounting, as we've learned, that's a basis of accounting where revenue and expenses are reported on the income statement in the period when cash is received as it relates to revenue and when cash is paid as it relates to expenses. And then we'll also discuss some examples of businesses that use the cash basis of accounting. And then from there, we'll transition into the accrual basis of accounting. And under the accrual basis of accounting, this is when revenues and expenses are reported in the income statement in the period in which they are earned as it relates to revenue. And revenue is earned when you have provided the service or you've sold the product, and expenses are incurred when you've consumed the service. All right, so the main thing for this chapter is its emphasis on preparation of adjusting entries, and then we'll discuss the 4 basic types of deferrals and accruals. And then we'll also discuss depreciation. So the learning objectives for this chapter, by the end of this chapter, you should be able to describe the nature of the adjusting process, journalize adjusting entries for accruals, journalize adjusting entries for deferrals, journalize adjusting entries for depreciation, summarize the adjusting process, prepare an adjusted trial balance, and lastly, describe and illustrate the use of vertical analysis in evaluating a company's performance and financial condition. So in Chapter 2, the transactions were recorded using the double entry accounting system. And after all of the transactions were recorded, there was an unadjusted trial balance that was prepared. And as we know, the purpose of the trial balance is to ensure that the total debit balances equals the total credit balances. However, before financial statements can be prepared, some accounts on the unadjusted trial balance must be adjusted. And these adjustments are necessary because the transactions were recorded using the accrual basis method of accounting. So for example, in the event that you purchase the bulk of supplies in advance at the beginning of the month, it's very likely that at the ending of the month, you've used up some of those supplies. So therefore, you need to ensure that the ending balance in the supplies account reflects the actual amount of supplies that are left on hand. So under the accrual basis method of accounting, we have the revenue recognition principle, and we have the expense recognition principle, which ties into matching. So under the accrual basis of accounting, revenues are reported on the income statement in the period in which a service has been performed, provided, or a product has been delivered. The key thing is that once you provide a service or you sell a product to a customer, they can either pay you right away or they can pay you later. So under this accrual basis of accounting, it does not matter if the customer pays you before or if they pay you after. The key thing is, was the service performed or provided, or was the product sold? And once the answer to that question is yes, then you must recognize the revenue as earned. The accrual basis of accounting also requires that expenses are recorded when they are incurred, not necessarily when the cash is paid. So the same concept applies. When you have an expense, it's either you pay for it right away or you pay for it at a later date. So under the accrual basis of accounting, the exchange of cash, whether it is before or after, has no impact. And this is in a comparison to the cash basis of accounting, where we know that revenues and expenses are reported on the income statement in the period in which the cash is received or the cash is paid. So that is the key distinction between the accrual basis and the cash basis. The key thing with the cash basis is, was there an exchange of cash? Did we receive payment or did we make payment? And if the answer is yes, we record it on the income statement. Under the accrual basis of accounting, was the revenue earned and was the expense incurred? If the answer is yes, then it must be reported. Next, we have these principles. So under GAAP, which is generally accepted accounting principles, we have these revenue and expense recognition. So to be useful for decision making, financial statements must be provided on a periodic basis. As a result, the economic life of a business is divided into time periods such as a month, the quarter of a year, which is equivalent to 3 months, or a full year, which is 12 months. It can either be a calendar year, which is from December or January 1st, rather, to December 31st, or a fiscal year, which is essentially any other 12-month period. So when you think of a fiscal year, think of it from birthday to birthday. With each birthday that you see, you are a year older. So again, there's calendar year, January 1st to December 31st, or a fiscal year, any other 12-month period, birthday to birthday. So under the revenue recognition principle, revenues are recorded when earned, which is when the services have been performed, provided, or when the products have been delivered to the customers. Revenue is normally measured as the assets are received, such as cash, which is when the client pays you right away, or accounts receivable, which essentially tracks the amount of money that customers owe you. Next, we have the expense recognition principle. So under the expense recognition principle, the expenses incurred in generating revenue must be reported in the same period as the related revenue. This is also called matching principle. So the expense recognition principle is also referred to as the matching principle. So by matching revenues and expenses, net income or loss for the period is properly reported on the income statement. And adjusting entries are required to properly match revenues and expenses for the period. So the adjusting process, as we discussed, is required, right? It needs to be done before the financial statements can be prepared and issued. So at the end of the period, once the unadjusted trial balance is prepared, and again, that verifies that the total debit balance is equal to total credit balances. As we mentioned, some of the accounts on the unadjusted trial balance, they require adjustments for several reasons. Some expenses are not recorded daily. So for example, the use of supplies, it would require many entries for small amounts. So a better way, a more efficient way would essentially be, okay, we started off the month with $800 worth of supplies. At the end of the month, we have $500 worth of supplies left. So based on that logic, 800 minus 500, that lets us know that we've consumed $300 worth of supplies. Another reason is that some revenues and expenses are incurred as time passes rather than separate transactions. So for example, rent received in advance, which is unearned rent, it expires and becomes revenue with the passage of time. Some revenues and expenses may be unrecorded at the end of the accounting period. So for example, a company may have provided services to customers that it has not billed or recorded at the end of the accounting period. The analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. The journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. So all adjusting entries affect at least one income statement account and one balance sheet account. Thus, an adjusting entry is always going to involve a revenue or an expense account, and it will also include an asset or a liability account. So it's important to be able to determine the types of adjustments that will be made. So we have what's called an accrual. An accrual, that essentially occurs whenever revenue has been earned or an expense has been incurred, but it has not yet been recorded. So the two general classifications of accounts requiring adjustments are accruals and deferrals. So if the accrual is for revenue, then the adjusting entry is going to debit an asset, accounts receivable. We are expecting to receive the money. and we credit revenue. And if the accrual is for an expense, then the adjusting entry debits an expense account and credits a related liability account, such as accounts payable or wages payable. So here we have an example of what the journal entry would look like. So accrued revenue to transaction is that the revenue has been earned. There's no journal entry that has been made. So now we need to make the adjustment because the revenue has been earned. So at the end of the period, our adjusting entry is a debit to accounts receivable to increase our receivable asset balance and a credit to revenue to increase our revenue balance. Next, we have an accrued expense. The initial recording of transaction has taken place, but there's no journal entry made. So at the end of the period, we need to make an adjustment. An expense was incurred, so therefore, we debit the expense account to increase our expense, and we credit our accounts payable or any other payable liability account to show the increase. And as mentioned, an adjusting entry will always involve a revenue or an expense account and an asset or liability account. And another way to me that I find helpful when you're thinking about accruals starts with the letter A. After also starts with the letter A. So when we think about accruals, we can also keep in mind that the exchange of cash happens after. They pay us revenue after we've provided the service or we've sold the product. We pay for the expense after we've incurred the expense. So after in accruals, the exchange of cash happens after the event has occurred. So next we have a deferral. And deferrals occur when cash related to a future expense or revenue has initially been recorded as a liability or an asset. So we see the distinction between the two. When we are dealing with accruals, the cash payment happens after the revenue has been earned and after the expense has been incurred. Deferrals, on the other hand, payment, the cash is received before we earn the revenue, before we even provide the service or sell the product, and the expense is paid for before we actually consume, before we use up the expense. So if the cash received is related to future revenue, it's initially recorded as a liability using an account called unearned revenue. And the adjusting entry in a period when the revenue is earned debits an unearned revenue account and credits a revenue account. If the cash is paid and it's related to a future expense, it's initially recorded as an asset called prepaid expense. So the adjusting entry in a period when the expense is incurred debits an expense account and credits a prepaid expense asset account. So here we have an example of unearned revenue, which is also referred to as unearned revenue or deferred revenue. So the initial recording cash has been received for revenue that will be earned in a future period. So our initial journal entry, we will debit the cash to show the increase, and we would credit our unearned revenue liability account to show a liability. We have an obligation to provide this service to the customer or sell the product. So now at the end of the period, we need to assess, has any portion of this revenue been earned? And if the answer is yes, we would debit the unearned revenue account to decrease the liability balance. And we would credit our revenue account to show the increase for the revenue that has been earned. Next, for our deferred expense, also referred to as prepaid expenses. For our initial recording, the transaction is that cash has been paid for a future expense. We debit our prepaid expense account, which is an asset. We credit our cash account because we are paying cash, so there's a decrease to our cash asset account. And then at the end of the period, we need to determine, has any portion of the prepaid expense been used to generate revenue? And if so, we debit our expense account and we credit the prepaid expense asset account in order to decrease the balance. So here we see in this example for net solutions, we have the unadjusted trial balance. So we see our total debit balances ties to our total credit balances. So we're good to go. And then now we start to look at the expanded chart of accounts for net solutions. And here we see accumulated depreciation, which is office equipment. We have wages payable. We have rent revenue, insurance expense, and depreciation expense. So as it relates to accrued revenues, during an accounting period, again, some revenues are recorded only when the cash is received, when we are under the cash basis of accounting. But at the end of an accounting period, there may be revenue that has been earned but not yet recorded. So in such cases, the revenue is recorded by increasing debiting an asset account, which is our accounts receivable, and increasing crediting our revenue account. So here it says, assume that Net Solutions signed an agreement with Danker Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, Net Solutions have provided 25 hours of service. The revenue will be billed on January 1st. So here we see our journal entry as follows. We debit the accounts receivable. Again, customers either pay us now, which is cash, or later, which is accounts receivable. So we debit our accounts receivable and we credit our fees earned. And then here we see the impact on our accounting equation. The value of our assets increase. Likewise, the value of our stockholders' equity revenue account also increases. So one of the key reasons why these transactions need to be recorded is because if they're not, there's an error on the books. So if the adjustment for the accrued revenues of $500 is not recorded, fees earned and net income will be understated by $500 on the income statement. And on the balance sheet, assets, accounts receivable, and stockholders' equity will also be understated. So here we see the issue. Net income would be understated by 500 because we failed to record the revenue. And the same thing for our asset balance, it would also be understated because we failed to record the accounts receivable that is due. Next, we have accrued expenses. Some types of services used in earning revenue are paid for after the service has been performed. And at the end of the accounting period, the amount of such accrued but unpaid items is an expense and a liability. It's an expense, we incurred it, a liability because we have an obligation to pay it. This adjusting entry is necessary so that expenses are properly matched to the period in which they were incurred in earning revenue. So as we discussed earlier, the expense recognition principle, which is also referred to as the matching concept. Net Solution pays their employees bi-weekly, so every 2 weeks. During December, Net Solutions paid wages of $950 on December 13th and $1,200 on December 27th. These payments covered pay periods ending on those days. So as of December 31st, Net Solutions owed $250 of wages to employees for Monday and Tuesday, which is December 30th and 31st. So thus, the wages expense account is increased with a debit by $250, and the wages payable account is increased, credited by $250. The adjusting journal entry and T accounts are shown in the next exhibit. So here we see they paid wages expense for December 2nd to the 13th. And then they paid wages for December 16th to the 27th. And then we have these 2 days that fall outside of the period. So therefore, we need to set up the accrual for the expense that is going to be paid in the next month, the next year. So our journal entry would be as follows. We would debit the wages expense account and we would credit wages payable. And this is our impact on the accounting equation. Our liability increases by $250 and our stockholders' equity expense decreases by $250. So it essentially remains in balance. So as shown in the previous exhibit, Net Solutions paid wages of $1,275 on January 10th. And this payment includes the $250 of accrued wages recorded on December 31st. Thus, on January 10th, the wages payable account is decreased, debited by $250, and the journal entry for the payment of wages on January 10th is as follows. We would debit wages expenses for Wednesday, Thursday, and Friday. We would decrease our liability for December 30th and 31st in the amount of $250, and in total, we would be paying cash of $1,275. So much like with our accrued revenues, we need to ensure that we are also reporting our accrued expenses as well. And the reason being is because if we do not, then there would be errors in our financial statement. So if the adjustment for wages in the amount of $250 is not recorded, wages expense will be understated by $250, and the net income will be overstated by $250 on the income statement. And on the balance sheet, liabilities, wages payable, will be understated by $250, and the stockholders' equity, retained earnings, will be overstated by $250. So there would be an effect if we fail to record this journal entry. Next, here we see adjusting entries for deferrals. So here it states December 31st, unadjusted trial balance of Net Solutions indicates a balance of unearned rent account of $360. And this balance represents the receipt of 3 months' rent on December 1st for December, January, and February. At the end of December, 1 month's rent has been earned. So therefore, there's a necessary adjusting entry that must be recorded. So we would decrease our liability by $120. It's $360 for 3 months. So we divide 360 by 3. That means that they earn $120 per month. So we debit our unearned rent, the liability account, to decrease it, and we credit our rent revenue account to increase the balance in this account. So our accounting equation impact is as follows. Our liability will decrease by $120, and our revenue will increase by $120, so it essentially nets out. So if the following adjustment of unearned rent and rent revenue was not recorded, much like all of the other entries, our financial statements will be misstated, they will be incorrect. So if we fail to record this entry, our revenues would be understated and our liabilities will also be overstated. So next we have our prepaid expenses, which refers to our deferred expenses. So the December 31st, 20-year 3 unadjusted trial balance of Net Solutions indicates a balance in the supplies account of $2,000. In addition, the prepaid insurance account has a balance of $2,400. Each of these accounts requires an adjusting entry. So here in this example, for our supplies, we would debit our supplies expense account for the value of the supplies that has been used up. So here we see we started off the period with $2,000 worth of supplies, but at the end of the period, we only have $760 worth of supplies left. So think of it like your bank account. You started off the month with $2,000, and now your ending balance is $760. That means that you've used up $1,240. So we debit our supplies expense account and we credit our supplies account for $1,240. So based on this entry, there is a decrease to our asset account for $1,240, and there is also a decrease to our stockholders' equity in the form of the supplies expense account. And next we have prepaid insurance. So same logic, it says that the debit balance of $2,400 in Net Solutions prepaid insurance account represents the December 1st prepayment of insurance for 12 months. So at the end of December, the insurance expense account is increased, debited, and the prepaid insurance account is decreased, credited by $200. the insurance for 1 month. So how do we calculate this amount? As it shows us here, 2,400, which is the total amount paid, divided by 12 months. So therefore, we paid in advance, and each month that elapses, we essentially have used up the insurance on our end, and the company that we have paid in advance, they earn the revenue. So this is the impact on the accounting equation. Our asset balance decreases, so does our stockholders' equity expense account by $200. So if we fail to record this entry of supplies of 1,240 and insurance of 200, then the financial statements are going to be misstated. So in such case, our expenses would be understated. We're missing out 1,440, which is the total of the supplies used and the insurance. So therefore, our net income would be overstated. Our assets would be overstated. We will still show $2,000 worth of supplies, and then we would still show $2,400 worth of prepaid insurance. However, as we just discussed, this is incorrect. So therefore, we need to make the adjusting entry so that way assets are not overstated, and to ensure that stockholders' equity is also not overstated. So whenever there's payments for prepaid expenses that are made at the beginning of the period, they will be entirely used or consumed. So to illustrate, the following December 1st transaction of Net Solutions is used. So it states that on December 1st, Net Solutions paid rent of $800 for the month. On December 1st, the rent payment of $800 represents prepaid rent. However, the prepaid rent expires daily, and at the end of December, there will be no asset left. So in such cases, the payment of $800 is recorded as rent expense rather than as prepaid rent. In this way, no adjusting entry is needed at the end of the month. So it's very important to consider whether or not the prepayment, if it is going to affect more than one period. And as we see in this case, this is just going to be this one period. We just automatically recognize it as an expense versus having to do extra entries to adjust. So another type of adjustment deals with depreciation, right? So depreciation is essentially just highlighting the fact that sometimes fixed assets, plant assets, they lose their monetary value or they decline in usefulness. So fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have a long life. Examples of fixed assets include land, buildings, and equipment. So in a sense, fixed assets are a type of long-term prepaid expense. Fixed assets such as office equipment are used to generate revenue, much like supplies are used to generate revenue. Unlike supplies, however, there's no visible reduction in the quantity of the equipment. But instead, as time passes, the equipment loses its ability to provide useful services. And this decrease in usefulness is called depreciation. So all fixed assets except land lose their usefulness and thus are said to depreciate. And the reason why land is not depreciated is because land is always useful. Right? So you might live in a neighborhood where you've seen 1 minute a plot of space is a restaurant. Then the next thing you turn around, that plot of space is a grocery store. And then next thing you know, that plot of land is maybe a home. So land is always useful. Reason being, you can always build something on land. So as a fixed asset depreciates, a portion of its cost should be recorded as an expense. This periodic expense is called depreciation expense. The adjusting entry to record depreciation is similar to the adjusting entry for supplies used. The depreciation expense account is increased, debited for the amount of depreciation. However, the fixed asset account is not directly decreased. We do not directly credit the account for the fixed assets. And this is because both the original cost of a fixed asset and the depreciation recorded since its purchase, they're reported on the balance sheet. So therefore, that information is crucial. And instead, they have a specific account called accumulated depreciation. And this account is credited increased in order to offset the value of the fixed asset. Accumulated depreciation accounts are called contra accounts or contra asset accounts. This is because accumulated depreciation accounts are deducted from their related fixed asset accounts on the balance sheet. The normal balance of a contra account is opposite to the account from which it is deducted. So we have contra asset accounts and we also have contra liability accounts. So just keep that in mind. And here it says, because the normal balance of a fixed asset account is a debit, the normal balance of an accumulated depreciation contra account is a credit. So here's just some titles for fixed assets. We have land, as we pointed out, land is not depreciated. Then we have buildings, store equipment, office equipment. And the contra asset account for our buildings is accumulated depreciation, buildings. For our store equipment, accumulated depreciation, store equipment. And for office equipment, accumulated depreciation, office equipment. So here we see in December 31st, 20 year 3, the unadjusted trial balance of Net Solutions indicated that Net Solutions owns 2 fixed assets, land and office equipment. Land does not depreciate. However, an adjusting entry is recorded for the depreciation of the office equipment for December. Assume that the office equipment depreciates $50 during December. The adjusting journal entry and T accounts are as follows. So we would debit depreciation expense for the $50, and we would credit our accumulated depreciation for $50. So therefore, now when we look at the financials, we see the balance sheet, we see that we paid $1,800 for the office equipment. However, we paid, or we recognize rather, depreciation expense of $50. The net book value for this asset is no longer $1,800. It now becomes $1,750. And then next we look at the shareholders' equity. Because it's an expense, as we know, there's a decreasing effect to our stockholders' equity. So after the adjusting journal entry is recorded and posted, the office equipment account still has a debit balance of $1,800. The difference between these two balances is the cost of the office equipment that has not yet been depreciated. So this amount is often referred to as the book value of the asset, or the net book value, and we calculate it as follows. The book value of the asset equals the cost of the asset minus accumulated depreciation. And the book value of the office equipment is the cost of the equipment minus the accumulated depreciation of office equipment. So the office equipment and its related accumulated depreciation are reported on December 31st, 20 year 3. $1,800 for the office equipment, and in this contra account, accumulated depreciation, is a $50 decrease, so therefore, the value, the net book value is $1,750. So the market value of a fixed asset usually differs from its book value. And this is because depreciation is an allocation method. It is not a valuation method. We are essentially just allocating the initial purchase cost of the item. We are not valuing it, trying to determine the fair market value if we were to sell it. So the effect of omitting the adjustment for depreciation, expenses would be understated, whereas net income will be overstated. Our assets would also be overstated. And then our stockholders' equity would also be overstated. So there's a great impact when these adjusting entries are not recorded. So adjusting entries are dated as of the last data period. And because collecting the adjustment data requires time, the entries are usually recorded at a later date. And an explanation is normally included with each adjusting entry, just to kind of highlight, give those who are working on the books or something of the nature, they have an understanding of which adjusting entries were made. And then that also ensures that it is accurate. So here we just have a summary of the adjustments for accrued revenue. So example, service performed but not yet billed, and they're waiting to receive the income. services have been provided to the customer and not recorded. So therefore, we debit the asset account and we credit the revenue account. And we know that it will have an impact on both our income statement and balance sheet if we fail to record it. Same thing for our accrued expenses, wages or salary, or any expense for that fact that's incurred but not yet paid. We debit the associated expense and we credit a liability account because there is an obligation to pay. Unearned revenues, unearned rent, magazine subscriptions, things of that nature. The cash is received before the services have been provided or the product has been sold. So therefore, there's a liability, there's an obligation to be able to earn it. So when it is earned, now we will debit the liability account to decrease it, and we will credit the respective revenue account for which it was earned. And then we have the prepaid expenses. This is when we pay for expenses in advance before the expenses actually incurred. So now at the end of the period, when we determine that, okay, we've used up a month, so therefore the supplies, we need to ensure that the balance is correct. Insurance, we need to ensure that the balance is correct. We debit the expense account and we credit the prepaid asset account. And then we have depreciation. This is again, once a fixed asset loses its value or its usefulness over a period of time, we essentially need to account for that. So we debit the depreciation expense account, and then we credit the accumulated depreciation contra account. So these are just some examples of some of the journal entries that were recorded for Net Solutions. And now we see that after all of these journal entries have been recorded, the balances are now updated. So our accounts receivable balance is now $2,720. Our supplies balance is now $760. Prepaid insurance is now $2,200. Accumulated depreciation is $50. The wages payable balance is $250. Our unearned rent balance is $240. Our fees earned balance is $16,840. Rent revenue $120. Wages expense $4,525. Then we have these last few accounts. Supplies expense, the adjusted balance is $2,040. Insurance expense, the adjusted balance is $200. And our depreciation expense, the adjusted balance is $50. So after the adjusting entries are posted, an adjusted trial balance is prepared. The adjusted trial balance verifies that our total debit balances and our total credit balances tie before the financial statements are prepared. And the key thing again is we want to make sure that all of the adjustments were made so that way the balances that are reported are accurate. And if the adjusted trial balance is not balanced, then there's some type of error and it needs to be resolved. So here we have in this example, the adjusted trial balance for Net Solutions. We see that our total debit balance and our total credit balance ties, so everything is good to go. Next, as it relates to analysis for decision making, vertical analysis. All right, so one of the key things is to compare each item on a financial statement with a total amount from the same statement is useful for analyzing relationships within the financial statement. So we use this vertical analysis, and it's the term used to describe such comparisons. So in the vertical analysis of a balance sheet, each asset item is stated as a percent of total assets. Each liability and stockholders' equity item is stated as a percent of total liabilities and stockholders' equity. In vertical analysis of an income statement, each item is stated as a percent of revenues or fees earned. And the vertical analysis is useful for analyzing changes in financial statements over time. So here we have in this example, the fees earned. We're looking at the income statement. So we essentially, let's say we're looking at wages expense. We would divide wages expenses by the fees earned. We would divide rent expense by the fees earned, etc. So Vertical analysis, again, it's important. The analysis can be enhanced, it can be used for industry averages and things of that nature to determine, hey, is XYZ company doing as good as ABC company? So ratios are definitely helpful. And again, that's the purpose of the financial statements. They're used both internally and externally to make sound business decisions. So that brings us to the summary. And now that the lesson has ended, you should have learned how to describe the nature of the adjusting process, journalize the adjusting entries for accruals, journalize adjusting entries for deferrals, journalize adjusting entries for depreciation, summarize the adjusting process, prepare an adjusted trial balance, and lastly, to describe and illustrate the use of vertical analysis in evaluating a company's performance and financial condition.